Hey guys, this is Rich Klein from the Diamond Law Group. Today we're going to be discussing how to remove your private mortgage insurance, also known as PMI, from your existing loan. Due to recent appreciation, you may qualify to have this removed, and we're going to discuss how to do so. Beforehand, let me show you the original disclosure that you signed, provided you took out a non-FHA loan. FHA loans have different types of mortgage insurance, but for our purpose, the principle is generally the same. So included with some of your original loan documents might have been something known as an amortization schedule. What an amortization schedule is it shows you how your payment is broken down on a monthly basis and then on an annual basis, demonstrating what is applied towards principal, which is not a lot, and what's applied towards interest, which is a lot at the beginning. Over time, the original balance of your loan will go down. And once the balance reaches 80% of the original value of the property, which we'll define in a minute, you can request your PMI come off. A lot of people think that it's automatic, that your PMI comes off after your loan to value reaches 80%. That's not actually the case. And here's the reason why. The original value they define as the contract is the lesser of the sales price or the appraised value. Just because you have a higher appraisal doesn't automatically mean that your lender is going to utilize that as the price. So it goes by the sales contract price. Further, whenever you do request, again, it is not automatic at this time, you have to have good payment history, which they define as not being more than 60 days late within the last 2 years or more than 30 days late within the last 1 year. And you have to be current at that time. What most people believe is that the automatic PMI comes off. That is true. However, it's when the original value, again, the lesser of the contract price or the appraisal, reaches 78%. The loan has to get to 78% for it automatically to come off, not automatic when it gets to 80% above. All right. So if you do nothing else and make your payments, the PMI comes off at 78%, though you can apply for it to come off at 80%. There's other exceptions for certain types of loans, such as if you have a balloon feature or no right to refinance, but those are usually rarer types of loans. The actual form that we're going to use here, right? Every bank has their own different ones. It specifically states that you have to pay for your own appraisal if necessary, or a BPO broker price opinion is generally the cost for the borrower. All right, so this would be a sample of one of the forms that is used. And then they give you the breakdown, which is what we're going to concentrate on here today. At any point of the life of the loan, based upon the original value, which again we defined as the lesser of the purchase price or the appraisal, it's automatically going to come off for a 1 to 4 family home. The LTV requirements is going to be 80%. This is when you can request it to come off, and they do require a valuation. If it's less than 2 years since you took out your loan, again, based upon current value, you need to demonstrate that there were substantial improvements made to the home. And again, this is based upon current value, not the original value. So if you're saying that the value has gone up because you made substantial requirements, improvements to the property, that is within the last 2 years. For your primary, it's the same threshold, 80%, and they do require another appraisal, be it a BPO or other valuation. If you took out the loan between 2 and 5 years, based upon current value, and you have not made any improvements to the home, for a single family home, it's 75% loan to value. And if you have made improvements within the last 2 to 5 years, then it is again at 80%. All right. So just to compare that to 2 years, you had to make substantial repairs. And on this one, there's an option where you could not have made substantial repairs, but the loan to value is 75%. If you did make the repairs, it's still the same 80%. They do require evaluation. Anything longer than 5 years, you don't need to make substantial improvements to the home, and it's still the 80% threshold, and they do require evaluation. Again, it doesn't necessarily apply to balloon payments and other modifications that might have taken place since you originally took out the loan. So if you believe that you fit within one of these criteria, you should contact your bank and arrange for them to conduct the valuation in order for you to have the PMI removed. Hope you guys found this helpful. Take care.